Good morning. We are pleased to see you. Tim Geithner joins me at an appropriate time. A little bit later, the U.S. government will be releasing their own numbers for the last quarter of the GDP numbers for the last quarter. We will not know them by the end of this conversation, though. When you talk about Tim Geithner and Ben Bernanke, you're talking about two people who have been on the firing line since the beginning of the economic collapse, and Ben Bernanke remains at the Fed, and Tim went from the New York Fed to Secretary of the Treasury. He may not be a candidate for President Obama's basketball team at the center position, but he is called in the White House Giant Tim. He looks on 2 years here of real legislative accomplishment between health care and financial reform, and he has had the challenge, I think, of saying to everyone about economic reform and about the disaster that we faced, it could have been a lot worse. And we now see in the United States a growing economy, and we see in the United States unemployment beginning to add jobs, but he would be the first to tell you that there is a lot that remains to be done. Warren Buffett told me a couple of days ago when we were talking about coming out here, because I'm going to see him in Washington on Saturday, that his grade for Tim, he said his grade for Tim in terms of how they have handled this thing was an A+. He's a relatively tough critic. If you look at the auto company, you look at TARP, and you look at those things in which they had tough calls to make, those calls seem to have been paid off, but there remains a lot to be done. So what I'd like to begin with is welcoming Tim Geithner, the Secretary of the Treasury of the United States.
Thank you, Charlie.
And we will have an hour, but I'd like to also get your questions involved in this, and so let what he says resonate, and we'll have an opportunity to include your questions. Questions per se sometimes define what's on the minds of people. So what are you hearing here at this conference? What do people want to know?
You know, I haven't been here in several years, but it feels very different. Obviously feels different. I think there's more confidence now that the most acute part of the crisis is behind us, absolutely in the United States, but I think that's even true globally. And I've only been here for 24 hours, but what people have been asking me about are, how's Europe doing? What about the U.S. and China? And how confident are you that the American political system will be up to the very substantial challenges we still face as a country?
I want to touch on all of those. Tell me how confident you are that the American political system can look at the challenge of economic growth to reduce unemployment and a long-term, very difficult and very large debt.
Well, I spent a lot of time, around the world talking to my counterparts, and I would not trade their challenges for ours. I would not trade our challenges for theirs. We have a very tough set of choices to make, very tough set of reforms to undertake, principally on the fiscal side. But we are in a dramatically stronger position today to confront those challenges, and we are in a relatively better position to confront them. We're still a younger country than the other major economies. Our underlying growth rates are more rapid, more dynamic. Productivity growth, really uniquely among the major economies, was very strong through the crisis. We have a much more open economy, are still much more open to immigration, and I think therefore much better positioned to benefit from the extraordinary talent that exists around the world. And so even with the challenges we face, I think we're really in a much stronger position today to deal with those challenges. And I think the great strength of the American political system is it has always risen to the challenge. Sometimes it takes a little time. It's always a bit messy. It's never perfect. But America will act and does always act. And even if you think about just the last 2 years, and even if you try to put in context that underlying concern that I began with about whether Washington will really move soon enough on these long-term things, I mean, Washington, at a time of crisis and with a very divided country, did do exceptionally important things over the last 2 years, not just in financial reform or even in healthcare reform, but in terms of starting, I think, the most promising set of reforms of education in the United States we've seen in a long period of time, and beginning to seed a very substantial increase in investment in basic science and research. And those were changes and reforms, I know they're messy, but reforms that were necessary. And it was the American political system that delivered those reforms, again, even at a time of a deeply divided country in the middle of crisis. So I'm, of course, very confident about America, very confident about the United States. And even with acknowledging the formidable nature of our challenges ahead still, with unemployment so high, I'd prefer ours to those of many countries.
Any regrets about the last 2 years in terms of, or from even before 2008, but from 2008 to 2010, in terms of whether you did enough, in terms of whether the stimulus should have been changed, whether the stimulus should have been larger?
We did what we thought was necessary at the beginning. We looked at the experience of countries around the world, and the president, to his enormous credit, decided at substantial political cost that he would try to move very aggressively at the beginning and use the basic full arsenal of financial economic policy alongside what the Fed did very early in the crisis. And because of that, we broke the back of the financial panic really quite quickly. It started to turn even in March of 2009. And you saw growth come back really extraordinarily quickly given the magnitude of the financial shock. And we knew that, again, looking at experience, that the typical mistake governments make in crisis is to stop too soon, to shift to restraint too early at the first signs of life, and we were not going to make that mistake. So we knew that even with what was still an exceptionally strong, powerful set of policy measures at the beginning, that we may have to come back and reinforce those measures, change their shape. And of course, that's exactly what we've been doing, which is we've been, as the nature of as the crisis receded and the nature of the challenges shifted, we've tried to shift the thrust of policy to things focused more on things like investment incentives, long-term investment infrastructure. And those are the things you need for long-term growth, not just to reinforce the recovery.
You mentioned that there was a recovery. That recovery seemed to stall in the eyes of some people. And so they ask now, when you look at the recovery that seems to be taking place, are you sure in your assumptions as to where we are and where we're going with respect to the U.S. economy?
Well, let me tell you what I hear what you hear from businesses in the United States and outside the United States and from investors. I think there's much more confidence now that we've got a sustainable expansion. It's not a boom. It's not a expansion that's going to offer the possibility of a rapid decline in the unemployment rate. But I think there's much more confidence now that's sustainable, much more confidence that we're able to avoid the risk of slipping back into recession or even a long period of what economists call below-trend growth. And I think that confidence is justified. And if you look at how sentiment has changed over the last 6 months or so, and this really began, and look in terms of the numbers, it began really in August and September, you've seen, I think, justifiably more confidence that we're going to be growing now at a reasonable rate. I think the private economists now think the U.S. is in 11 and 12 is going to grow between 3 and 4%. And
you think that's reasonable?
Well, I'm not a forecaster or an economist. And what matters, again,
you have to make assumptions.
We do.
Treasury Secretary.
We do, but what matters really is what's the average expectation of the market and what's its distribution, what's the how strong are the pessimists still in that context. And again, what's I think mostly encouraging about sentiment these last few months is that the people who've been most concerned about the risk of a long period of below-trend growth or slipping back into recession, they seem much more confident now that we're going to be growing at a reasonable pace. So our job, though, is to make sure that happens and make sure we don't risk leaving the economy with unacceptably high levels of unemployment for a long period of time.
What do you think the business community and the community that will be feeding consumer demand are looking for? Are they looking for certainty? Or are they looking for something else that will just say to them, it's time to make an investment in capital allocation, time to hire people?
Well, I think you're seeing that happen already. I mean, again, it's just for perspective. Private investment in the United States in capital equipment and software grew in the first half of last year at a roughly 15% annual rate. It's still growing really quite rapidly. I think that demonstrates you're seeing businesses decide they need to start to put capital to work to bet on the fact that the world is now going to be growing. And, we've had 1 million private sector jobs in the last 12 months or so. That came earlier, more in number than what happened in the last 2 recessions. And you're seeing both those trends, I think, start to gain momentum. But I think it's worth Charlie, just looking at the big strategic imperative for the United States. I think we're at the beginning of I still think the very early stages of what will be a very long period of exceptionally rapid growth in large part of the emerging economies around the world. They're going to be a much larger share of global output, of global growth, of demand. And the United States is exceptionally well positioned to benefit from that and take advantage of it because the things those economies need to grow, American companies are still really uniquely good at. And what policy in the United States should be doing is trying to make sure that U.S. companies and foreign companies investing in the United States are going to be a substantial participant in that huge wave of growth ahead. And you're seeing that happen now. You see, U.S. exports are growing really quite rapidly. Exports to China growing at twice the rate of growth of exports to the rest of the world. And the things that have been traditional strengths of the American economy, the quality of higher education, the basic dynamism of the economy, the speed with which we adapt to change, the underlying dynamics of innovation, I still think they seem encouragingly strong. We want to reinforce that, and that's why the President in the State of the Union was putting such attention to innovation, education, investment, and the broader reforms that have to make that possible. That's the right agenda for the United States. And I think, again, the early shape of the recovery should be encouraging.
The global economy, some of those figures have been revised for next year up to 4.8%, and that includes 7 or 8 or 9%. Do you worry about inflation in those emerging nations?
I think anybody who's a central banker in an emerging economy is not anybody, but in those countries that have been growing quite rapidly earlier coming out of the crisis, are seeing more pressure, and they're facing a more complicated set of challenges in making sure they can contain inflation and deal with this big surge of capital flows to those countries. It's, again, driven by optimism about how strong growth is going to be. But those are world-class challenges to have. They're familiar challenges to policymakers. Countries have had decades of experience in managing those challenges. They're up to doing that. I think it would be easier for them to manage those challenges if you saw countries like China and other emerging economies soften their link to the dollar. Because if they do that, they'll have a little more flexibility to manage those inflation pressures and not risk getting behind accelerating inflation. But for the global economy, given that 2/3 of the world, the major economies, are still in an early stage of coming out of this recession, I would not put inflation on the global level at the high list of concerns.
So what do you worry about with respect to the global economy?
Well, I think just to start where you began, I think that the most important thing now, apart from the United States doing what it needs to do to repair the damage caused by this crisis, and I should say, and I'm always the first to admit, the U.S. made some very substantial mistakes in how we ran our financial system. Those caused enormous damage, not just to our credibility and to the American economy, and we're going to be living with the echoes of that shock, those mistakes, for a long time, but they caused a lot of damage to the world. And
when you say that, you're speaking of the failure of enforcement of regulatory authority?
Right. We just, ran a indefensibly antiquated, I would say, terrible financial oversight system, and it wasn't the only cause of the crisis, but it was a substantial cause of the crisis. And it is the obligation of anybody in policy in the United States to acknowledge that mistake and make sure that we are doing everything we can to fix our challenges here. But apart from what we do, which is still, of course, enormously important to how the world fares, I think that it's very important to see Europe, and they will do this. I have no doubt that they're going to be able to do this, to make sure they put in place a framework that allows the countries that have such difficult fiscal and reform challenges to let those reforms take hold. And still allow and I'm very confident they'll be able to do that.
You are confident that they will be able to manage this problem?
I do.
Of sovereign debt.
I'm very confident. They have no alternative but to deliver on their unequivocal commitment to make sure they're standing behind those countries and their financial systems, because I think they recognize that there is no alternative to the reforms that they're taking. But for those reforms to work, they need a period of time, and they still need to be able to fund. Funding is the oxygen of economies in the financial system, and it requires that kind of commitment of the rest of Europe to deliver. So that's obviously still a dominant concern, appropriately so, not just for Europe.
But let me just stay with that for a second. Are you convinced that they have done enough so far, and that they will be prepared to do, in your conversation with central bankers and finance ministers, that they are prepared to handle the problem of sovereign debt, whether it's Greece or Spain or Portugal or Italy?
Well, I don't think any of them would say they've done enough, and they're now in the prospect of trying to shape the next stage of, you might call it escalation on the reform side and the financial side. But that's really a question for the European authorities. I think the important thing is they've made it clear that they're going to hold it together and not take risk that you'd see reignited a broad withdrawal of confidence in Europe as a whole.
What impact did it have on the U.S. economy, the sovereign debt issue in Europe?
I think it had a significant impact in slowing the momentum of recovery at a delicate point. And the reason why that happened is, most of the world was still understandably quite scarred by the trauma of the crisis. The memories were still quite raw. And when they saw this broad erosion in the capacity of the political system outside the United States to manage what were a very complicated set of challenges, that was very destabilizing to confidence. And you saw equity prices in the United States, for example, fall between 10 and 15% in a relatively short period of time. That is a very substantial shock to the American economy. But fortunately, in part because Europe then moved to fix it, that was relatively short-lived. And after that brief loss of momentum, the U.S. economy started to regain a little strength starting in August, September, and that has built momentum since.
President Sarkozy and Chancellor Merkel, I think, have said that they're confident that the euro will survive, and I assume you're prepared to let them speak for the euro.
Yeah, I will leave that to them, but I would share that confidence.
When you look at the biggest issue, let's take Japan for a second. They recently, Standard & Poor's lowered its rating for Japan's long-term debt. What did that say to you? And what does it say about other countries in the industrialized world who are not part of those we've already mentioned? And what does it say about some possibility of the United States?
I think I'd rather speak directly to the U.S. question rather than coming at it through the Japanese context. Japan's.
Were you surprised, though, at the Japanese?
Well, Japan's a very high savings economy. It's true they have a very high level of debt. But Japan's main challenge, and this is true really everywhere, is how they're going to grow in the future, how to make sure they can achieve a level of growth as the population ages that can support those broad obligations, and that's going to be a challenge for them like many countries. But let's come to the United States because it's so important. I think that Americans in policy understand that, and I think it is the dominant, a much greater recognition now across the American political system that our fiscal position is unsustainable over the long run. And it's going to require a substantial set of changes to the balance between our resources and commitments to bring that under control. And we're in the process of just trying to figure out how we can build a consensus to make that happen in a way that's going to be fair and preserve strong fundamentals for future growth. And our system has a lot of strengths in terms of how we make fiscal policy, and it has some important weaknesses and challenges. Our strengths are that the president is obligated to put out a budget that lays out policies for 10 years. And those are evaluated by an independent authority, in this case the Congressional Budget Office, which has to judge what they produce in terms of deficits over time relative to the economy as a whole. And when the President lays out his deficit, his budget in a few weeks, you'll see our view of the best way to bring those deficits down over time to a level that's sustainable, and how we can do that without hurting not just the near-term expansion, but making sure we're strengthening the underlying fundamentals for investment and growth in the United States, for innovation and education. And the fact that we have to do that and it has to be evaluated independently is a good, important strength of our system. Our challenge, of course, is that is just the beginning of the process. Congress, under the Constitution, has to legislate policies. And our real problem now is that we do not have a device in the American political system now that allows Congress to commit itself credibly over a multi-year period to policies that will offer an enforceable commitment to bring down deficits to a sustainable level. And that is our challenge, to figure out how we can build that type of framework that allows a multi-year commitment, because, just to come back to a question you asked a few minutes ago, what businesses and individuals need is the ability to understand over time how we're going to solve that. They know we have to solve it, but the ideal thing for incentives and for confidence, for certainty, is to lay out a path for how we're going to solve those things that allow people to plan and to adjust. And the earlier you begin those reforms, the more time you give people to plan for their impact and adjust to them. Now, these are within our capacity to solve. Again, our challenges on the fiscal side are much more modest.
Within our political capacity to
absolutely,
solve.
Absolutely.
No question.
No question.
There is a political will to deal with the long-term entitlements are at the core of our deficit issues.
I would say the political will is not fully manifest yet at the moment, but it's coming. There's no alternative to it. There's no way to avoid it. We can't grow our way out of it. But again, if you look at our position relative to that of the rest of the world, it is going to be easier for us to bring ourselves down to a more sustainable level than without hurting growth. It'll be true for many countries. We just need to make sure we can start the process soon.
Do we have here a real conflict between the necessity of growth because you want to deal with unemployment and a deficit issue and a debt issue that goes to the long term? Well, are they in conflict so that you have to say to everybody, we're trying to spend over the next several years, get the growth thing going, and then we'll deal to the deficit and the debt? Is that the sort of mantra of what you're saying?
Yes, I think that as you do this, you've got to make sure that you don't hurt the recovery and take much risk that you do a lot of damage to an early expansion by shifting too prematurely to substantial restraint.
Sort of putting the brakes on.
And we're not going to let that happen. I know there are some people who would like to have it, they don't want to hurt the economy, but they'd like to move very quickly to do very deep cuts in spending. But it's not the responsible way to do it. It would undermine their long-term objective of making sure we achieve a more sustainable fiscal position. So we have to have that process start more gradually, and I think we can do that. But again, for that to work as a strategy, you need to be able to try to lock in politically things people can count on and be confident will bring down those long-term deficits.
That is the political debate in Washington today.
Well, it's starting. The hard thing in thinking about fiscal reform is not the accounting question of how you narrow the gap and how low you need to get it, but how to do it in a way that's not going to hurt growth, incentives, growth fundamentals, and it's going to be fair, judged as fair to the broad, community of your citizens. And that is always a political challenge. In the U.S., again, it's magnified by the fact that under the system we have, we need to find a way to get Congress to commit itself to a multi-year framework and bring down those deficits.
So when you have a congressman calls you up and says, convince me that public works is the thing to do when I feel so strongly about spending, and that's what got me elected in the first place, and my second big issue is the long-term debt.
Well, there's no one who lives in the United States or sits in Washington can avoid the fundamental reality of the fact that we have this unsustainable gap between we don't have unlimited resources, and I think people recognize that now. So when we talk about things like investment in education or in basic research and science or even in infrastructure, we need to do that in a way that is affordable and is responsible and is consistent with the imperative of bringing down those deficits. And we need to make sure we're going to be paying for things that cost money, not ignoring their basic cost or hope they don't in the end or hope they pay for themselves. Those are the constraints we have to live with. And I think that reality is much more widely accepted in Washington than it was, for example, over the last 10 years or so. You don't hear people in Washington, well, you do hear some people, but not as many people say, tax cuts pay for themselves, or that we can grow our way out of these things, or we don't have to live with some set of constraints. I think that's changed in the political debate in the United States, and that's helpful. But again, the critical test of credibility for us should be, can we find a way to lock in multi-year commitments to a responsible path to restore sustainability so we can begin those changes, not let people adjust? And can we do that in a way that's going to preserve basic incentives for investment so that we're not hurting what have been the classic fundamental strengths of the American economy in innovation, in higher education, things like that?
What is the most important thing that's going to grow the U.S. economy?
Just those things. The basic fundamentals of growth are going to be, they're, I think, universally accepted. They're the quality of talent you produce through your education system.
Right.
They are the capacity of government to make sure it's investing in things only governments can do, because the market will not produce on its own the right level of investment in basic science and research. It's improvements in the basic quality of public infrastructure, which have a lot to do with the cost of running a business in the United States, and they are in making sure your financial system does a better job of allocating capital to where the returns are highest.
But the reason I ask that is that there's still money, I understand, from the original stimulus program for infrastructure that has not been spent.
That's actually the overwhelming majority of the initial resources in the Recovery Act have been committed.
They haven't been
are
spent.
not well, a substantial number are being spent. Some are still ahead of us, but that will not be sufficient to repair and rebuild the basic public infrastructure that all economies need to operate more efficiently. So there's a very strong case, as the President said, for a long-term, multi-year commitment. We have to pay for it to make sure that roads, highways, et cetera, are brought more into the modern era.
David Cameron, as he left here this morning, stopped to say hello to Secretary Geithner, and he said, "Tell your president that I, with great admiration of the State of the Union speech, and in fact, I'm going to recommend our speechwriters take a look at it." My question is, what happened? I mean, in terms of competitiveness, these were a lot of the things that the president already been thinking about. Did he simply say, this is a way to connect the dots in terms of growth, in terms of the economy, and at the same time do things that we need to do for the long-term health of the United States? Or did he wake up one morning and say, by God, I've read all these things, we really are in trouble here, in competition with a new world of emerging nations? What happened?
These basic priorities were part of what he began at the beginning of the administration. But, of course, they were eclipsed in the public mind by the challenges of putting out the financial fire and the early task of designing reforms to make sure Americans can enjoy health care.
But eclipsed in terms of his preoccupation, or eclipsed in terms of the public attention in the United States?
I really think the latter. I mean, remember, it wasn't just a financial crisis with an economic recession much deeper than most Americans had seen in generations. It happened at a country that's still quite divided, deeply ambivalent about what the right role of government is, and with a very determined, quite formidable political opposition that chose, as a matter of strategy, to stand apart from those early imperatives of managing the crisis and reform. And I think that made it harder. But these basic core things about education, innovation, investment were part of the early design of the Recovery Act, and what he's doing now is building on those. I'll just say one more thing. And again, if you think about what's changed in the last 6 weeks, I think you can see evidence of this. I think it is really important to confidence in the U.S. generally, not just among Americans, but people outside the United States, to see examples of people in Washington trying to solve basic problems, some of them from the center, ideally. And you did see in the last few weeks of the year, not just in the tax package, but other things, a pretty encouraging capacity to actually get some things done that matter a lot. I think that helps confidence. And what we've been trying to do, and we started this process in September when the President proposed a series of new reforms to investment incentives, to try to find things that Republicans have supported, that they'd be willing to do with us, for example, a Korea free trade agreement, or perhaps corporate tax reform to strengthen investment incentives, things like that, so that we can help build more confidence in the United States and outside the United States that, again, there are people in Washington willing to come together and solve some problems. Now, again, there's a lot of things that will divide Democrats and Republicans for a long period of time, and there are people in both parties that are going to want to make sure those contrasts are sharp and compelling to their constituents. And we have to find a way to still rebuild the capacity to act, because we cannot legislate now without Democrats and Republicans, and the things that matter to how we grow in the future, they do require Congress. There's not things we can do, just the executive branch.
That raises two questions. Number one is there have been changes at the White House in terms of the chief of staff, in terms of the head of the economic advisors, Gene Sperling. It is said that, and many of them work for those two, the chief of staff, work for President Clinton. It is said that this economic team is more centrist than the previous team. And you are now the captain of the team, and if not already the captain of the team. But these are more in line with the views of Tim Geithner.
That is true. But all of what you said is true. No, I'm just kidding. But I actually don't think the center of gravity...
Which part was true? That you're the chief of in charge of the team, or that they're all centrist and they're like you?
What the following is true is it is an excellent, talented group of people, me accepted. But I think the basic center of gravity around the team reflects the president's basic values on these things. I don't think they've changed. I think what's changed is that we've been able to put the worst part of the crisis behind us, and we can now focus attention on things that matter a lot to long-term growth.
So part of the message of the Obama administration, we've been struggling to make sure that we just survived, and now we can focus on the future.
Well, the immediate, urgent, overwhelming priority for us, nothing was possible without it, was to break the back of that crisis and do it as quickly as possible. And the president was willing to spend a huge amount of political capital without much support, frankly, in making those changes early. But now, we've been growing now for 6 quarters.
Right.
And it is right now to try to shift the center of the political focus to things that are about education, about innovation, about investment, because those things matter not just for the here and now, but for the long term.
Characterize it. It was said in a piece by Peter Baker in the New York Times, a very interesting piece about jobs, which we haven't talked about, which I want to talk about, that you and the president had bonded. Therefore, it gives you a unique place to define him. Christina Romer said that he's a moderate, middle-of-the-road guy. Is he a centrist, a pragmatist? Is that where he is in your judgment?
Absolutely, but he recognizes, like we all do, that the test of policy is what is going to work to make a difference in people's lives, the things that matter to how we do as a country, the quality of opportunity we give people. And his test, and I think the test for all of us, should be what is going to make a difference. What's the most effective way, stepping back from politics with a fair amount of flexibility and pragmatism, that's going to make a difference. But, this president is doing fundamentally necessary, important reforms to how any market economy functions, like in education or in the incentives you create for how people use healthcare or energy, those things like that. But he's doing so in a way that recognizes that the job of government is to help shape the incentives and make sure that there's the basic infrastructure network that economies need to function. And if you want to call that centrist, that's fine. Other people will call it other things.
What would you call it?
I don't think I can characterize it. At least I leave that to him to do. But the criteria. I'll give you one other endorsement of our president, which is that since I get to help make policy, advise policy, there's a huge gap. You can see it all across the world now between what the economy requires and what political systems are comfortable trying to do. And it is the basic test of leadership and of heads of state is to figure out how to make possible politically things that are essential and necessary economically, be willing to take risk on those things, not let what seem to be the political constraints out there prevent you from moving on things that matter hugely. And that requires a willingness to take risk politically and spend a lot of capital. And he has been enormously supportive from the beginning of recognizing that you have to be willing politically to take those risks early, or you're going to be living with much longer-term damage and costs to things that matter for economic health. And that's enormously important, and we're really fortunate in that.
And would you say that most of the measures that took place to thwart the crisis and to create a recovery out of this threat of the greatest depression since the Great Depression simply were matters of things that work and not a question of a philosophy about government and the economy?
Well, the people tend to look at the competing strategies for dealing with a financial crisis and try to characterize them as two extremes. There's sort of you might call it the liquidation strategy, to say, let the market solve it. And there's some people say, that just to use the pejorative, I think, unfairly, is to say you should choose the broader, they might call it the nationalization strategy, have the government massively socialize, take on all those risks. And we tried an approach in the United States that was very different from that, and it was enormously successful. What we did is we said that we would try to recapitalize the financial system as quickly as possible with a framework that maximized the chance that private capital will come and do that work for us. And the things we put in motion in the stress test were designed to make that much more likely. And alongside that, we try to take the catastrophic risk out of the broader financial markets by making a lot of commitments to make sure there was more liquidity, less extreme risk in the broader funding securitization markets. Those were untested strategies, but they were enormously effective very quickly. And I think we were lucky that we moved so quickly to adopt them, and it allowed us to bring about a very substantial restructuring in our financial system and to get out of the investments we had to make early on much, much more quickly at a much higher return financially than otherwise would be the case. I'll give you an example. The S&L crisis, which was in the several decades ago, was a crisis much more modest in scale, a much tamer type of financial challenge. That cost the United States directly about 3% of GDP. The similarly measured financial costs, direct financial costs of this crisis for the United States, all in across the Fed's programs, the GSEs, TARP, the broader investments, the FDIC we made, are almost certainly now going to be under 1% of GDP. That is an exceptional outcome relative to expectations, and it was possible because not just of those early choices on strategy, whatever you call them, whatever you label them, but also because you had such powerful support from monetary policy and fiscal policy early on.
So clearly that's happened. Clearly we have an economic recovery on Wall Street. Clearly we have an economic recovery in the corporate sector. Clearly in terms of unemployment, we do not have an economic recovery. So tell me what you think will be done over the next 2 years. And some people, I think the Congressional Budget Office among them, believe that unemployment may drop by the end of 2012 to 8%.
You believe those figures?
I think, again, the private forecasters would say that on the expectation the U.S. economy grows between 3 and 4% over the next 2 years, that unemployment will be in the range of 8, maybe slightly below 8 at the end of 2012. I'd say there's a tighter consensus on that now, but these things are inherently uncertain. Unemployment only starts to fall when you see economies start to grow again. Growth has to come first, and again, we're now about a year and a half into positive growth now. And as this economy, continues this process of recovery, you'll see more people put back to work. What's interesting about the United States is GDP, the overall output of the economy in the United States is now above the pre-crisis level. But unemployment is still roughly in the range of 10%.
Now, why is that?
Well, it's partly because of the way the U.S. economy works as a whole. What you saw in the crisis, because people were frankly panicked that the world was going to come to an end, you saw American companies cut deeply into the payroll base, the employment base, with just brutal force. And they have been more tentative because of the scale, because of the sort of the aftershocks of that trauma of bringing those people back to work. You've seen hours start to increase more early. I mean, the more hours they asked people to work, part-time work came back early. But you saw people a little more tentative in adding back full-time people early, although, again, as I said, we've had 1 million private sector jobs, 12 months of private sector job growth, which is faster than the last 2 recoveries. So that's encouraging. But I think it's fundamentally the trauma caused by that shock to basic confidence. But that's going to, we're healing now, and that's going to start to improve. But a recovery that follows a crisis like this, a crisis that is the legacy, the result in part of too much borrowing by households and by the nation as a whole, those recoveries, by definition, by necessity, it's unavoidable, will be more modest, more moderate. There's no way to avoid that. And that does consign us to a much more, I would say, a tragically more moderate path of reducing unemployment than any of us would like.
Some suggest it'll be 2016 until we get back to 5 or 6% unemployment, which is considered full employment. You agree with that?
Well, Charlie, I don't do forecasting. I don't believe much in it. But I don't think its record is particularly good, and I'm not an economist. What we can do is try to make sure we're making sure that that people who are responsible in Washington and Congress and the executive branch are doing things that are going to make it more likely that we grow and we bring that unemployment rate down as quickly as we responsibly can. That's our obligation. And again, I think what's happening now is encouraging, but we have a lot of challenges ahead. Not just in the scale of the size, level of unemployment, the trauma you still see in the housing markets, and these long-term imperatives of trying to improve quality.
So when are you going to tell us what you're going to do about Freddie Mac and Fannie Mae?
In a very short period of time, a few weeks, and I'm glad you raised that because again, even though I think the core of the U.S. financial system is much stronger, and I think the basic framework of reforms we legislated last year with Barney Frank and Chris Dodd leading the charge, is a very strong framework of reforms, addresses the core challenges in our system, but we still have a mess in the housing finance business. It's now almost completely dependent on the government, and we're going to lay out a set of reforms to crowd private capital back into the housing finance business, to dial back the role of the government over time, and leave us with a system that will not be vulnerable to the really tragic, colossal failures, not just in Fannie and Freddie, but more generally in underwriting practices, oversight of the finance.
And you have more consumer protection.
Absolutely.
Do you worry that one of the 50 states or more may go into bankruptcy?
I don't particularly know, but I would say that that's not to understate the difficulty you have if you're a governor in those states now or a mayor in the cities in those states now. It's still going to be very hard for a long period of time. But because the economy has been growing now and because the revenues are starting to improve yet, those pressures are diminishing. But there's still a long period of adjustment reforms that those states have to go through.
And that's been a casualty. States have been a casualty of the economic crisis.
Absolutely. And Congress did a lot in the first 2 years of recovery of trying to ease that burden. But the force of the pressure is diminishing, not intensifying.
All right, China. You mentioned it earlier. Hu Jintao has said that this is not a zero-sum game. We can do well, and you can do well. You have been a long-time observer of China. I think you may speak Mandarin, but
I would never claim to speak Mandarin, although I did study
I'll rephrase the question.
Did you study Mandarin? I did study for a long time.
For a long time?
Yeah, not long enough.
You've also been part of the security and economic dialogues that have taken place here in China and in the United States. So where are we after this state visit, and what came out of it? And do the Chinese reasonably have the right to say, we have shown that we are, as strong as the United States on the world stage, and there's no bigger player than we are?
I don't think they would ever claim that.
They wouldn't say that.
They would not say that. Some people in China would, but not the leadership of China. I mean, again, what China's done in the last 30 years is just amazing, remarkable. The most impressive basic transformation than I think you've seen. And they have this remarkable capacity to set those long-term goals and basically execute them. But the Chinese in power would be the first to tell you that, they're one-third the size of the U.S. economy. They're, in terms of per capita income.
But many people think that they won't be one-third the size of the U.S. economy.
No, they're closing.
20.
They're closing the back. That's inexorable. But
one by one, they're replacing whoever was ahead of them.
Right. But they have a really remarkably difficult, complicated set of challenges. Not just demographically, because the labor force is going to start growing relatively soon. But they are still at the early stage of building the basic architecture of a market economy. They still have an economy overwhelmingly dominated by the state, where resources are allocated by the state, not by the market, and they are committed to that path of reform, but they're early stage. But to come to your question, I think that what you saw is both President Obama and President Hu acknowledge that our fates are so closely linked, and that the world depends a lot on how effectively we together manage this basic relationship, how we figure a way for us to be growing together, to be pursuing policies that are not just in the interest of what we have to do domestically, but are in the broader interest of a growing world economy. And I think that recognition is very important. And what we want to do is try to strengthen the incentives China faces to continue on this path of reform, to rebalance their economy, to move to a more market-oriented, more flexible exchange rate system, and to help join us in trying to shape a system that will work for both of us going forward. China was not there when the U.S. And parts of Europe built the post-war economic system. They were not present at the table then. They benefited hugely from being able to take advantage of that system over the last 30 years or so. But that system is going to have to adapt and change. And what we want to do is to, we're going to have our interests we're going to pursue, and they're going to have their interests they're going to pursue. But we want to make sure that people in both countries recognize that those interests are in many ways closely tied. They're not fundamentally in conflict. They're largely complementary. We want to make sure they're comfortable that we're going to be able to build a system that's going to accommodate their interests too, not just ours.
Any possibility that state capitalism, in your judgment, will be a competing model for other countries around the world?
No risk of that.
No risk. No. I want to finally say, as we look at this, you expect to be Secretary of the Treasury through the 4 years of this administration?
I only answer. There's only one way you can answer that question.
As long as the president wants me there.
I'm tempted to say I hope not, but I will serve as long as the president
and if you
asks me to serve.
and if the president wins re-election, if the president wants you to be in his government, you would be finding it hard to turn him down, whether it was Secretary of the Treasury or Secretary of the State or
President will absolutely win re-election, although I'm not a politician. And he'll have a chance to make sure he has good people working with him to shape our future. And it's been it is a great.
And the most important lesson you've learned?
There's so many, and it'll take a long period of time. But there is no. I say to when you talk to people in university or people who are just coming out of college now, what I say to them is that you have to come work for your country. Sometimes there is no greater experience, no greater privilege, nothing more interesting or challenging. And in economic and financial policy today in the United States, no better time to do it.
All right. Thank you very much, Treasurer Tim Geithner. Wait 1 second. We started here about, as I look at my watch, maybe about 5 or 6 minutes late. Any questions you have before we close off this? Anybody wants to ask? I can't see the house lights up, but yes, right there. Do you have a mic? Thank you, Tim. That was great. Yes.
Good afternoon, Mr. Geithner. Thank you so much for what you've done for the country. I started out as a skeptic, but I'm very proud of what has been accomplished. I just have one quick question. In many places in this forum, we've been asked whether we should have more or less government. But the question of effective government has not been addressed. I think it's not about more or less, but could you address how the U.S. government is making itself more effective and efficient? Thank you.
Well, I think you phrased it right. I mean, it is true that in many parts of the world, the state is just too large and its commitments are unsustainable. So when people say those commitments have to be brought back down to earth, restore gravity to the aspirations of governments, they're completely right. But you're absolutely right. What matters is the effectiveness with which governments do things that only governments can do. Because there are basic things that, again, just in education, the framework of incentives and constraints you put on your financial system, what you do for basic science research, those are things that governments have to do. They have to do them well. They have to do them better than they have been done in the past, not just in the United States, of course. But I thought you said it right. It's about competence and creativity and care and the capacity to act. And it trivializes the challenge to say it's just about the math.
Thank you all very much, and our special thanks to Secretary of the Treasury, Tim Geithner. Thank you.